As debate grows whether the Fed's current path for hiking rates will cause a recession or not, a growing number of indicators suggest that policymakers might be behind the curve when it comes to inflation. So far in 2022, policymakers continue to tell us that they are data dependent. But the question is, are these data dependent policymakers looking at the right indicators? That's today's big conversation. Markets have become increasingly jittery in recent weeks, and there's no great surprise there. The S&P is up a cool 100% since 2020 lows, so selling does become an easier decision after such a strong run. And secondly, investors were wrong-footed by the sudden surge in US yields at the start of the new year. Now, we all knew it was coming, but the move was fast and equity markets reacted. Now, significantly, the VIX index has an average level of 24 year-to-date. In fact, it's almost 30 today. And it remains above a threshold which typically requires portfolio managers to be more active in their risk management. And that means reducing position sizes and potentially putting more hedges in place. And that, in turn, affects markets. The US central bank, the Fed, has the market convinced it's going to move quickly, with now JP Morgan pricing in 9 straight rate hikes to 2.25% by March next year, all at a time when inflationary pressures might well have peaked. And this conflict is only intensifying as investors become increasingly concerned by the direction of many traditional lead indicators linked to the business cycle and demand for raw materials. Take the Cass Freight Index, for example, which historically has tended to lead headline CPI by about 6 months. The year-over-year change in shipment volumes has just turned negative, which could be a rather bearish indicator of a future recession and coincident disinflation in the near term. And there are further signs of a potential slowdown in the real economy. Another key indicator of the US business cycle, the ISM Manufacturing PMI, may also have peaked with a reading of 64.7 in March 2021. Whilst that latest reading of 57.6 remains well above the 50 threshold seen as many as signaling expansion, base effects are now contributing to a negative rate of change over the past 12 months, similar to the Cass Freight Index. This has seen a rotation away from certain cyclical sectors, such as industrials, towards more defensive sectors, such as consumer staples. It's interesting to note the recent resilience in the relative performance of base materials, because historically, they have tended to underperform along with industrials during a downturn in the business cycle. But perhaps this time it is different, with the price of copper and other associated commodities remaining elevated and supporting the sector, which seems at odds with weakening in the pro-cyclical lead indicators we saw earlier. Focusing in on another inflation haven, consumer staples are traditionally seen as having greater pricing power to pass on higher costs. The latest US retail sales report surprised the consensus with a higher than expected reading showing growth of 3.8% month over month. But the unemployment rate has ticked up to 4% from a post-pandemic low of 3.9%, which has historically signaled a peak in the labor market where workers, think consumers, enjoy the most favorable terms in job security and higher wages. So the question is, for how much longer will consumers be able to absorb higher prices if labor market conditions begin to deteriorate from here? Despite some of the key leading indicators suggesting that inflation may be set to subside with a possible downturn in the US business cycle, there is evidence that considerable cost pressures could persist. Higher energy prices have been one of the main contributors to overall CPI ever since the supply issues took hold in the midst of the pandemic. Although demand was expected to normalize after the apex of the economic recovery, geopolitical tensions have sustained the rally in crude oil, with the WTI benchmark approaching $100 per barrel. And this volatility has not only created a great deal of uncertainty, but it also puts the pressure back on policymakers to intervene in an attempt to control inflation. And longer term, there is debate about whether energy transition will lead to higher prices for fossil fuels as a result of overinvestment in renewables. Now this, coupled with other current forces, could establish a new base level for energy costs, which would effectively tax the consumer, even if they are underestimated in future CPI owing to base effects. With so many competing variables around inflation and growth, the Fed is in an unenviable position when it comes to setting policy. Seems that sticking to traditional measures to gauge the true temperatures of the economy, and crucially inflation, might not be sufficient in an increasingly complex situation. Given the Fed's self-directed data dependence, there is potentially a lot more information that has yet to be gleaned and could influence their stance on interest rates. And that's why this week in the Chatter segment, I sat down with Mike Smith, Global Sales Strategist at LSEG, to discuss retail sales and why you need to dive a little deeper into that headline number. Mike, thank you so much for joining us. Now, we've just been talking about data points, but in particular, what data points central banks, particularly the Fed, are looking at when they come to making decisions about rate hikes. And I know you've been looking at a few data points recently, so I wondered if you could give us some of your thoughts.
Yeah, thanks for having me, Jamie. It's nice to be here. I sort of got into retail. So last week we had the retail sales number come out, and it was pretty robust. It was 3.75, 3.8%, for the month over month. And actually, when you span that out and you look at the annual number, it's I think 12 or 13% year over year. So it's a big number. But when you go out even further and you kind of stretch that chart out, you can see what we've gone through in 2020, 2021. Those numbers are really starting to get back, even though they're very obscene, if you want to call they're still muted from where we've been. And I think that's something we, as people that look at data, need to consider. I was listening to a podcast yesterday, and the guys were talking about, look, this last 2 years, it's broken every chart that I have on fundamental or economic data. So that's the hard part, I think. And you and I were speaking, we have to kind of take everything with a grain of salt when you look at it. And so I started to look into, instead of just looking at the headline number, let's look into the subsectors.
Okay, great.
Right? So the subsectors are interesting. The number one sector, it's about a 20% weight, is motor vehicles and parts. Right? It's got decent growth over the last year. And in fact, when you take it down and you go into the equities in that space, great. Easily explainable. Right? If you look at the number and you compare it to the RBOB, the gasoline futures, the correlation's like 80% or something crazy like that. So it's highly correlated. Now it gets out of whack once in a blue moon, but it's an explainable number. We can see kind of where that goes, right? So the Fed, it's a little bit easier to measure for them. They have an idea of what those markets might do a little bit more. Right. But then as you step down into some of the other, like the non-headline categories, you get like clothing and accessories, which is like a 20-something, mid-20s% growth year over year. The numbers are outstanding.
So does the question become, when you break down the subsectors, who is passing on costs and therefore margins are basically not expanding, and who isn't?
Correct, and I think that's some of the things you need to look at as you look into. The equities help you tell that, right? Because they're public companies, they have to report. But when you look at the NIAC sector data, which is pretty much the way everything is broken down, there's hundreds, if not thousands of companies in each one of those, but we're only getting a small subset of those, either in the index, or if you're looking at something like the Russell 3000, or even total public. A lot of them are pink sheets, so the reporting is a little off. But you're looking to see, like, are their gross margins expanding? And they don't seem to be. Like, they look at their relatively, a normal growth, which is what a company would try to do, grow margins a little bit.
So it seems like you're saying a couple of things which are really interesting. One is, we're seeing some big headline numbers, but go and look back even further, and you realize in the grand scheme of things, just pause for a second, because relatively speaking, we're not seeing massive jumps compared to where they've been historically. And then secondly, try and dig down into sort of specific sectors, because some of the numbers which may look like inflation are just, cost of goods being passed on, but you are seeing some margin expansion elsewhere.
Yeah, I mean, I think so. I found two major things in looking at the data. is one, is there inflation? I mean, yes, but
Right.
it's really inflationary from the last 2 years, right? You're seeing,
I see. Yeah.
So you saw such a big drop. I mean, some of the categories were off 80, 85%. Like I think it's clothing and retail was the biggest one. So it dropped something like 85%, and then we saw a month-over-month number sometime in April or the summer of 2020, and it was like 400%.
Right.
When you're off 80% to go up 400%, when you take that number and you break it down over 20 years, the chart just looks like it continues with a bunch of wobbles. And like I said before, with the broken charts, you're going to see some of that dislocation in the numbers, and it's just really take it with a grain of salt. Now, when we look at some of the raw commodities that go into this, which are causing this, there might be some instances there of things that, maybe we've seen lumber go up and down. Now that plays into the Home Depots and the Lowe's and those sort of retail aspects of things because people are paying more for lumber. So those are the sort of things that we have to be careful of, and I think the Fed has to be careful of, is what happens when we get back to a little bit more normal. And when I say normal, I mean spending going across all places, right? When I looked at the retail, a very small subset of that is services, and specifically in food and drinking, right? So that's one of the categories, and it's made up of McDonald's, Burger King, Starbucks, and they're all seeing big jumps in year-over-year numbers. And when you look at the numbers for this year, so the IBIS estimates for those, their increases are pretty solid, 20, 30%.
But this includes food delivery services as well?
So it includes those fast casuals, those ones that have taken on delivery as part of their mantra because no one was coming into the
restaurants,
office or the restaurant, to go out for lunch. I'm here in the office in the city today. Normally I'm at home buying lunch. So they're trying to make up for that with the delivery. But the ones that have really started to jump as we're starting to see this kind of get back to normal are the sit-down places. So that is the area in retail. And then what happens when we get back to travel, right? Travel's happening. It's still muted. I think it's causing some of the dislocation in retail too, because you're getting the gasoline on the demand side, you're getting motor vehicles, people are buying RVs, people are doing stuff that they can drive to. I know I haven't taken a really far vacation in the last 2 years. Everything's been in the Northeast area, around New York, New Jersey area. So we're driving to everything. It's changing to what we do, right? What happens when we start buying airline tickets and booking stuff overseas, and that starts to play into, does that mute what you're spending money on?
So this is the tricky situation for central banks and indeed the Fed, is how do they plan a rate hike policy based on data that's so skewed because we've had such a topsy-turvy few years. So it's a difficult one for them.
I think I heard this, I'm not going to take any credit for this, but I heard it on a podcast and I can't remember who said it. Right now, the Fed's in the place of they are trying to land an airplane on an aircraft carrier in weird seas at night in a rainstorm. That's their job right now.
Okay.
So there's so much going on to these variables, and I couldn't stop laughing. I shared that with a ton of colleagues about what they have to do, and you see it in the bond markets too. You're seeing the bond traders all over the place, 75 basis points, guaranteed, like 50 oh no, now we're probably at 25. So those numbers are all over the place, and I was getting into an argument as the equity guy who knows very little about those markets with our fixed income team going, they're not going to do it. They're not going to be able to do it. They're going to have to slow play this. And almost everyone's watching the Olympics. It's going to be like a curling match. They're going to have to go slow, wait every end, and try to see what happens with every stone that goes down, and try to figure out where are we now? What's my next play? How do we go from here? Because if they go too fast and break things, we're in trouble, and we don't know where we could be from there.
Well, Mike, thank you for those analogies. We've all got Top Gun with 747s in our heads now, but that's been great chatting to you, and thank you very much for coming in.
Excellent. Thanks for having me, Jamie. Appreciate it.